Welcome to Money, Money, Money. I'm Sumaira Abdi. With the surprise rate cut by the Reserve Bank and the subsequent transmission by banks, investors stand to gain by way of lower EMIs. But they're also staring at lower deposit rates, or at least the prospect of it, in the coming days. Well, in this scenario, how do tax-free bonds actually stack up against various other investments? Will they see waning interest because of rates now being near 7% almost? Or should investors actually rush to lock in money even at these levels? Vishal Dhawan of Plan Ahead Wealth Advisors joins in with his take. Hi Vishal, thanks very much for joining in.
It's a pleasure.
We know tax-free bonds actually offer interest rates which are a few basis points lower than the yield on the government bonds, right? Now, the 10-year government bond is already close to 7.7%. That means the interest rates on tax-free bonds could be closer to 7.25% or perhaps lower. Is that still an attractive rate for investors to be looking at, and which tax bracket?
So essentially, the way we look at tax-free bonds is that they are an important component of a fixed income portfolio for clients or investors. And very, very clearly, I think what investors need to do is take their fixed income portfolio and break it up into components. So just like they use, for example, the PPF as a long-term fixed income exposure, we think tax-free bonds can pretty much come into the same bucket. I think what investors need to do is look at what is called laddering of their fixed income portfolio, where essentially they get different maturities in there. And even though tax-free bonds today may be offering much lower than what they were offering a couple of years ago, I think you need to put this in the context of inflation. Inflation in India for the last 5 years has been very, very high. And we were actually sitting at a negative real rate of return during this 4 or 5 year period. For a change, with inflation coming off very sharply, you're actually seeing tax-free bonds even at 7 or 7.25 being very, very attractive vis-a-vis inflation. And therefore, we think that they continue to be very, very attractive options. I think what investors will need to do is spend a little bit of time resetting their expectations. I think the challenge that RBI has faced, and in turn the entire economy has faced, is inflation expectations in our country have been set very high. And I think we're now starting to see people accept that it is possible on a sustained basis for us to see low inflation in our country. So it does look like a very, very attractive proposition.
Okay, so attractive only if you were applying to a fresh issue, or what about the secondary market? Could people be looking at also buying over there?
So both of those are very, very attractive options. I think for investors in the 30% tax bracket, very clearly it's very, very attractive. I think even for investors who are on a 20% tax bracket, it does tend to be a fairly attractive option. There are enough issues also available in the secondary market. However, you do find that there does tend to be certain restrictions in the secondary market. One is liquidity is not that high. The way these bonds get bought is, they're actually kind of negotiated deals. And therefore, you'll find that to get access to them in the secondary market may not be that simple, especially if you want to invest a large sum of money.
Okay, but it can be arranged through a broker or an advisor.
Absolutely, it is possible.
Okay, so in this case, you're saying tax-free bonds are still an attractive option. How do they stack up vis-a-vis other categories in the debt space or in the fixed income space? I know you're saying that this is one of the categories you should be looking at independent of others, but comparatively, how are things between the various instruments?
So it's, again, if you try to break it up into buckets, right, and you get into, say, the 10, 15, 20-year bucket, which is essentially where a lot of these tax-free bonds today fit in, assuming you're going to hold it to maturity. You'll find that there are clearly PPF as an option, but it comes with a restriction that you can only put in a certain amount of money each year. And therefore, to the extent that investors can use the PPF, they should be doing that, because the yields are today significantly higher. We know that the government's already talking about linking PPF rates also to long-term bank deposit rates. So I think there will be some developments on that front. But having said that, we think that outside of the PPF, you find that long-term fixed income investments in India tend to be largely taken over by insurance products. The 10-year government security, 15-year government security, 20-year government security largely doesn't sit in retail portfolios at all. And even today, there is a clear tax inefficiency because interest on all of those instruments is taxed at your marginal rate, so in whichever tax bracket you may be. So I think clearly in the segment that we are in, which is the 10, 15, 20-year segment, there is really very few alternatives for investors. I think the moment you start looking at other instruments, you'd start looking at something which is, for example, debt mutual funds are very attractive for investors looking at money which is, up to 5 years. There's also big tax arbitrage available because of, indexation benefits if you hold for more than 3 years. So very clearly alternatives are available, but in the long-term space, these aren't so attractive. Even long-term FDs, for example, are very tax inefficient.
Okay, so in that case, what portion of a person's debt portfolio be allocated to tax-free bonds?
So it's a difficult question to answer because a lot of this is a function of when you require money to come back. The way we look at it is the biggest advantage of tax-free bonds is that they remove reinvestment risk in portfolios, which essentially means that if interest rates come down, you're not going to end up having to, reinvest at a lower rate. Typically, we'd say that investors for their long-term portfolios, 10, 15, 20 years, should be having more of their exposure to assets like equities and real estate, because those tend to, over longer periods of time, outperform fixed income. But the way we would look at it is that, for investors who have already allocated there or are comfortable with the fact that they need a portion of their money to move there, we'd say about 20 to 25% going to tax-free bonds is a good alternative.
Okay, and this is of the debt portfolio.
That's right.
Okay, now, we had the NTPC tax-free bonds issue, right? So that saw a huge rush because it came just before the rate cut was announced, right? And a lot of people were actually expecting rates to be cut, and therefore the rush. Will future issues still see this kind of appetite? And for those who have already may have subscribed to the NTPC issue, do you recommend that they also go in for further issues, or is, subscription to one enough? Or should they go in for multiple?
So I think, first of all, we think that this is going to continue to happen. So we know that there is a PFC issue, for example, just opening. And we expect that there will be huge oversubscription there as well. Because essentially the way these rates are getting set is that they're linked to the last 2 weeks government security rate averages. And therefore we think that this is going to continue to, at least, till this entire rate cut peters down. You will find that there will be a lot of demand for tax-free bonds. Essentially, our view on this is that if you take an issue like NTPC, for example, you'd find that investors who may have applied will probably get only maybe 20% of what they applied for, and therefore they'll be forced to go to other issues till they are able to kind of get the allocation that they wanted. In addition, you'll also find that there isn't necessarily enough of supply available all the time of these issues. So what people may end up doing is preponing some of their buys. So if you look at the last issuance, a lot of it happened in 2013. Then we had 1.5 year with no issues at all. And now again, you're probably seeing a lot of issues getting bunched up together. So I think what may end up happening is people may end up preponing some of their purchases just because of the way the issuances happen.
Yeah, because you don't know if next year there's going to be
That's right. And even though there's a secondary market, it's not something that a lot of investors look at very closely. So theoretically,
and it's also
everyone
not very
could buy
liquid in any case.
Yes,
right?
that's right.
Okay, now one final question. Deposit rates may be trending lower, but a lot of senior citizens, bank FDs, etc., are still offering very attractive rates, right? Some of them, in fact, 8.5%, 9%. Would it then make sense even for a retired person to have some portion of their debt portfolio in tax-free bonds, or do you think the senior citizen savings schemes, etc., are the way to go?
So I think one of the biggest drivers for decisions around that would actually end up being the tax bracket of the senior citizen.
Okay.
And obviously you'd find that they come in different categories. So what we'd ideally like to say is that if you're looking at, say, bank deposits or say in a senior citizen scheme as well, you'll find that they have maturities which are shorter. So you'll typically have a senior citizen savings scheme at a 5-year maturity. You'd have bank deposits going up to 10 years. Now the reality is that if you're 60 today and you're planning till 80, you don't have any fixed income instrument which can take you all the way up to 15 years or 20 years. And therefore you'll need to look at instruments like tax-free bonds to actually cover you, for that period between 70 and 80, where you're constantly being exposed to reinvestment risk. I think this is something that gets severely underestimated in retirement portfolios. Anyway, annuities are not very popular. And the way we look at it is that, if you're able to find an attractive long-term instrument and you also have liquidity taken care of through other investments that you make, then tax-free bonds are very, very good for retirement portfolios.
Okay, so I think it's an all-round thumbs up in any case. So a definite, a must actually for a debt portfolio.
Absolutely.
All right, so on that note, let's actually take a very quick break. When we come back, it'll be time to actually answer some of the queries which have been sent in by our viewers. Vishal is going to stay on with us, so do stay tuned.